Well, today it's a lovely day today in Abu Dhabi, isn't it, Adan?
It's very nice. Yeah. Good to be here.
Great, great. Thank you so much for joining us today. Look, my name is Eleanor Slinger, as I mentioned, and as Flo mentioned, and really proud to be here in Abu Dhabi and have seen some of the growth, especially from startups and fintechs around the region. But yeah, we want to give you a warm welcome, Dan, all the way from America as the CEO of North America. You've had roles previously, and I just wanted to get your journey and how have you been the last few months starting at Liquidity Group?
Yeah, it's been fantastic. So I'm about 3 months on the job. Joined Liquidity Group September 1st as CEO of the North American business, as you mentioned there. The prior 20 plus years, I was at Silicon Valley Bank, so working with tech companies, mostly in the United States. And the last role that I had at SVB was leading the national fintech team. So national being US. So Silicon Valley, New York, Boston, the major tech hubs in the US, and covering all the subsectors within fintech, including lending and capital markets, which, now I'm at a lending and capital markets company.
And would you say that there are any lessons and insights that you can bring from SVB to Liquidity Group, and what have you sort of seen as the opportunities?
Yeah, I mean, there's certainly things that I can bring. There's 20 plus years of pattern recognition across literally thousands of companies that we were working with. So you learn a lot. You've seen a lot of things go right. You've seen things go wrong, and I think especially around when to raise capital, how much to raise, what's the optimal structure, within the company's capital stack, like all of those things, very very well rehearsed, and like I said, lots of pattern recognition. Um, However, there are other things I'm learning, being at a more flexible and more nimble company now, like how quickly you can make things happen, for instance. And that's a breath of fresh air. I mean, SVB was great, by banking standards, in terms of making things happen. But it's nothing compared to being in a startup, where Monday to Friday every week you learn a ton about your business and about your client base and your capital partners and all of that. But Monday to Friday, you can also just make a lot of things happen. You can really move the business, because it's so much more nimble, so much more flexible, and everyone on the team is so much more focused as
Mhm.
well.
And how have you used AI and machine learning to sort of make your startup a little bit more nimble? What are the sort of ways that you're taking advantage of that?
Yeah, I mean, look at our core, we are an AI company, right? So we are an AI-driven asset management firm. We have a machine learning platform. We're ingesting financial due diligence data into that platform, and then analyzing that data and using the analytics on that, including predictive analytics, to deploy capital for our capital partners, mostly in the form of growth capital debt. Although we did just close our first growth capital equity fund, as well. That fund is focused on the Asia Pac market. So, we are an AI company, and that's the business analytics, but it's also predictive analytics around revenue, profitability, stress cases, and testing against like what a larger loan might look like versus a smaller loan, for instance, all those kind of things. And then importantly, also using those same analytics to manage the loans and the investments once we've made them.
And how important is it to be part of that financial mix for startups and being able to offer different types of capital?
It's critical. I think that for we're mostly working with tech companies, like the other companies that'll be on stage today. And, those companies typically need venture capital for product development. Um, there are other forms of capital that, and less dilutive forms of capital that come into play as they're uh, growing revenue, as they're expanding their operations. So they might still be dependent on venture capital to some degree, but there are these complementary forms of capital like what we provide in terms of non-dilutive financing that can be incredibly helpful to companies, especially in a market like this where venture capital equity is becoming increasingly more expensive or just not available.
And turning a little bit to yourself as a unicorn, I'm just wondering, are the pressures different now? And how do you sort of achieve 500% growth per year, as put in one of your releases I've seen? And perhaps what are the sort of expansion opportunities, and what do you see for the Middle East as an opportunity?
Yeah, I mean, look, there's opportunity everywhere, right? Middle East and beyond. How do you keep it up? That kind of growth. I mean, you've got to keep telling the story, right? You've got to be in front of all the prospective, customers out there, but also the influencers around those decisions, those financing decisions. So, venture capital and private equity firms are not the only channel that matters there, but they're one of the really important ones. And importantly, you got to keep scaling the company. And in our business, that means continuing to bring on new capital partners and more capital, right? So at our core, we're an AI-based asset manager. We got to keep adding assets, right? Got to keep attracting asset managers who want to back us and deploy capital across our platform. But we also have to keep scaling the business from a product perspective. And we at our core, we've got a decision science engine, that we use for underwriting. That is the core of what we're doing. We also need to continue to develop other products, around that make the solution and the workflow around it that much better. And generative AI is presenting itself as the way that we're doing that, right? If you think about everything that happens after an underwriting decision is made, what it takes to get through to sign loan documents and advancing money, there's a lot of work there. And we're using Gen AI to automate some of that workflow as well.
Yeah, the KYC process is not always fun for startups to have to do. And would you say that there's different criteria and different factors you can take into account because you have this different decision-making science?
Yeah, I would absolutely say that. It's, I talked about pattern recognition earlier, and I talked about it in a positive way. It can also be negative, right? Where everyone's just sort of chasing the same thing. And I think that having the machine learning driven AI based approach to analyzing these companies and underwriting the investments in these companies actually cuts through a lot of the bias. So we might be looking at a company that's in a sector that's actually out of favor, but the metrics that we're seeing in our system are very positive, right? The same kind of unit economics that the panel before us was talking about. And when we see that, it cuts through that bias that we might have around the sector, especially if the predictive analytics from our AI engine are taking into account the macro factors that would affect that sector, and we still like the opportunity, it helps you lean in that much more. The opposite could also be true, right? A company that's in a really hot space, but the metrics just aren't there. Having the AI-driven, metrics-based, data-based approach really helps us focus on companies that are actually performing.
Yeah. And you were saying earlier you've scaled into the region, you've hired people in the region, and you've recognized that there's potentially a funding gap. Would you sort of say that there is an opportunity for you guys to fund more of the startups here? And what kind of sectors would you pick for this region, if you could?
Yeah, definitely. Well, first, let me start with what we're doing here in Abu Dhabi. We have 50 people in this building, and we're hiring people all the time. Mostly product and data science here. A few people, including my colleague Carmen, who's somewhere here, who is more market facing, but a lot of product and data science people here. This has been a great place for us to grow our business, and it's now our second largest office and certainly our fastest growing office. Back to the point about scaling the company, Abu Dhabi and the support we've gotten from the ADGM and audio has been fantastic to help us do that. On the market, it's a younger market, but it's a super exciting one. And I think the fact that we're all here for multiple days in a conference in a setting like this is sort of testament to that. What's happening with ADGM and audio, and just the way that the entire ecosystem is organizing around leaning into tech and leaning into capital and capital allocators is, certainly a good sign of what's to come. But that said, the market's already, there are already great things happening here. So we did a deal with Trucker a couple of years ago. We recently just doubled down on that and provided more capital to them because, again, we like the performance, we like the metrics, we like what we're seeing there, and it's helping that company do even further expansion across the region. So that's a great example of the kinds of companies that are getting built and the way we're coming alongside of the management team and the equity investors to provide this non-dilutive financing to help them continue to grow.
And with that non-dilutive capital, is that more suitable for early stage to growth stage? Is there a sort of sweet spot that you would sort of imagine?
Yeah, I mean, look, I think in terms of the financing spectrum, there's a place for it everywhere. In terms of what we're doing at Liquidity, we're focused on growth stage. So think about the way that our AI platform works. We're analyzing basically invoice level data, so we can do a bottoms up build on all of the unit economics that the prior panel was talking about. And by looking at invoice level data, we're getting a granularity and a precision around that underwriting that a human analyst wouldn't. However, that basically necessitates that you have a lot of invoices, right? So the more customers, the more transactions, the more differentiated our analysis is going to be. So because of that sort of skews us to really focusing on growth stage companies. So companies that probably 10 million plus in revenue, still growing, and still looking for a market share that they can capture.
Do you see an opportunity to collaborate or partner with more traditional banks and how they bank? Is there any opportunities there?
I definitely think there's opportunity for that. I mean, we've, over the last couple of years, been this boom in the private credit space, which it's easy to sort of think about that as like, being completely outside the banking system. However, I think that there are plenty of opportunities for banks and private lenders to work together. We're already doing some of that, right? And syndicating deals or syndicating a few deals with banks. But I think that, look, if banks figure out how they want to play in this market, then I think there's definitely an opportunity to do deals together up and down the capital stack. I also think, back to my earlier comment around continuing to scale our product and use Gen AI to develop some of those workflow tools around the deal process. I think that is the type of product that actually is going to be attractive to many banks as well. So that might be a different way that we end up playing with banks, is actually licensing our software to them.
And I mean, that was one of my questions with how do you scale capital deployment quickly? I mean, is it just with the due diligence? Are there other factors? Is it trying to get more financiers into the mix as well?
It's all that. It's all that. I think that some of it is scaling the team, right, to make sure that you're in front of the right opportunities. You've got people with sort of the capital markets expertise on the team to scale the capital partnerships piece of it, and that you've got a great marketing engine. Actually, our CMO is here as well. You've got a great marketing engine that's telling the story and getting it out in front of the all sides of the market that matter. But importantly, we're also leveraging technology, right? It's not like to do more deals we have to hire more analysts. And at least that's not a one-to-one kind of relationship. We're in a much more scalable situation just because we're leveraging the machine for so much of the underwriting and decision making that we're doing.
And we're on the eve of COP28, which is very exciting to be here in the UAE this year. And I just wanted to understand, how do you build in the long-term goals of sustainability with the need for profit? How do you help startups achieve that?
Yeah, definitely. I think that's a conversation that starts in the boardroom for each of those startups. But I think that understanding how the impact that a company intends to have beyond just the return to shareholders, the financial return that is really important. I guess I can't say yet that we've got any analytics or in our model around like what the environmental or social impact might be for a company. But what we certainly can do is say, hey, that company that does have an environmental or a social mission or some kind of impact beyond just the business metrics, how is it also performing, right? Is it actually able to do the both and if so, that's a way we can support those companies.
Great. Well, that's good to hear. Well, look, as a final question for startups in the team, well, in the audience today, it'd be really good to get some of your tips and key lessons, and just to summarize, how can these startups take advantage of this new form of capital? How can they sort of achieve what you've achieved as a fintech yourself? And some words of wisdom, if you don't mind.
Yeah. So, there are a few things I would think about there. One is think about your capital, right? And be as capital efficient as possible. We're in an environment right now where that's sort of being forced on you as an operator. We were in an environment, a couple of years ago where everyone would have thought you were crazy to not spend as much as possible, right? So the everything goes in cycles, and just think about the capital resources you have, and think about how to allocate that, and be as capital efficient as possible. Doesn't mean don't spend, doesn't mean don't take losses if those losses are producing enterprise value in your company because you're gaining market share, expanding markets, developing product, whatever it is. But be capital efficient. And then the maybe closely related to that is just be open to how you're thinking about forms of capital. Um, as I said, most product development companies have some form of venture capital or other equity capital present in their cap structure already, and that's great. And you might need more of that as you grow. But think about the complementary forms of capital, especially non-dilutive financing, like we've been talking about here today.
Well, thank you so much for joining me today, Dan. It's been a pleasure to chat, and hopefully, there's been some pearls of wisdom for you all today. So, thank you so much. Enjoy the rest of the ADGF.
Yeah, thank you so much.